What's good, people? So we're back again with another video. So today's Wednesday. Market's about to close in like the next 30 minutes. Well, for the day, that is. And yeah, we've had FOMC today. FOMC came out. The actual interest rate was 3.75. The forecast was 3.75. So no surprises there. And that's what we were hoping to break us out of this range that we've been in for the, oh my goodness, let's see how long we've been in this range. Let's see, from the moment it was formed till now. We've been in here for like what? That's 9 days. 9 days and 8 hours. So we've been there for a long time, honestly. And yeah, it's just been going back and forth, back and forth, back and forth. No movement. I did say in previous videos that I do not plan on taking any trade unless we leave this range, godforsaken range. Now, as you can see here, this was a daily data point that was formed after the close of yesterday's candle. As you can see here, support was created. So there would have been a potential buy opportunity. So let's just investigate that a little bit, just for the sake of doing some technical analysis. Because even though there was a data release today, honestly, I personally just prefer to focus on the technicals. I feel like if you focus on the technicals, you'll more often than not, you'll be on the right side of the market. Whereas if you focus on fundamentals, a fundamental release can come out and translate to an asset being bullish, but then the asset just suddenly drops, which means maybe that economic release or whatever has already been priced in by people in the know. So honestly, people who are into fundamentals and shit on technicals, saying that only the fundamentals are what move the market. Well, yes, I understand that, but honestly, if you just follow fundamentals, you can also get tricked a lot of the times. In fact, you'll just be scratching your head, what the hell happened, because it won't make sense. Whereas if you follow technicals, more often than not, of course, the trend is your friend till it bends at the end, right? That kind of stuff. There'll always be a point or position where technical analysis will fail, but usually that happens at the end, right, when there's a turning point. Because let's say, for instance, an uptrend is a sequence of higher highs and higher lows, higher highs and higher lows. So the aim is to catch higher lows, right, for continuations in that trend. But then there's going to be a higher low that gives you a confirmation signal. You'd get maybe, for instance, a bullish engulfing or some form of pin bar rejection on a lower time frame, or even a lower time frame break of structure at a lower high point. And you're going to take that signal in anticipation of the trend continuing in its original direction. But then maybe it will give a slight reaction, and then it will go down and take your stop loss out, and then break structure. Well, that's the only way that structure is going to break. The only way for structure, for the trend to change, is for structure to break. So of course there are times where your technical analysis will fail, and that's okay. It's part of the game. Nobody said this was a 100% win rate kind of game. So to use that as an excuse to say, oh no, technical analysis doesn't work, I think it's complete bullshit. But anyway, let me not get in a rant. Maybe I'll make another video and then go in a whole different rant. Well, I'm not saying that technical analysis is better than fundamental analysis, or fundamental analysis is better than technical. And I'm not even saying, oh no, the best thing is to combine the two. No. Do whatever the fuck works for you. That's what I'm saying at the end of the day. So yeah, basically, now if we look at this, now looking at this, we're just trying to analyze this. So you see, this was the data point on the daily, and as you can see clearly, there was a low, higher low, higher high, and then a lower low, and then a break of structure. So clearly, as we can see, of course, this is hindsight. I hate being a hindsight hero, but then how else are you supposed to learn about technical analysis, right? So I know a lot of people be like, oh no, this in the past, but what? How else are we going to turn? I mean, that's why we have like tools like FX replay, or even the replay chart here. You go back in time, see what happens, but then what you do is you apply it to your technical analysis, to your methodology, right? You don't just keep on changing methodologies and picking and choosing which methodology to use at what point. That's what's wrong about, maybe going back in hindsight and then fitting what happened to a different frame of analysis. No. You got to stick to the same analysis and see if that analysis would have worked in previous data. So like, I didn't even like go through this analysis. But I noticed from that, I didn't even go to the hourly time frame honestly, but I noticed from that H4 that there was a rejection and it pushed up. So going to my hourly, which is usually my entry time frame, what I saw was okay. What I'm seeing now is that okay, see there was a sweep and then there was a breakup structure. So anyone any kind of technical analysis you do would people will recognize this as a good sign that prices will go higher. Now you see it went high, it created a high, created a low, created a higher high, even though it didn't close it, but there was a price did trade higher than the previous high, and then it started to range a bit up until the news release, right? It even came here, tapped the level. This was, I think, that this is at the point that this level was tapped for the first time. So this was the fresh tap. After tapping this, honestly, it gave a bullish engulfing, right? And let's see what time was this. This was around just before New York open. It gave a bullish engulfing, right? So if let's say there wasn't a news release here, like at FOMC at this time, because FOMC came out. This is the FOMC candle. So let's say there was no news release today. This would have been my entry. After seeing that rejection, let's say I didn't, because sometimes, let's say I didn't enter on the rejection itself, like after the close of this candle, seeing this nice pin bar rejection, right? If I didn't enter, I needed a little bit more confirmation. I'd wait for a bullish engulfing, and you got the bullish engulfing candle right on the next candle. So my entry would have been at the next candle. I either enter immediately or I maybe wait for a little pullback. Usually I like to enter at the 50% of the candle that actually engulfed, right? So I would place my order somewhere here and I wait for price to pull back just so I can get a better risk reward, and I'll put my stop below here. And as you can see, this would have, let's plot it out. We got time today because this whole week we haven't placed any trades. So this is what I would have done. That would have been my 50%, right? Let me zoom it out a bit so we can clearly see. This is all just for educational. So this is what I would have done. I would have placed my long somewhere around here. Now, of course, I don't always just enter on the 50%. I try to see, is there a valid data point around that area? Now, the closest data point would have been here, but depending on how I'm feeling at the time. Now, as you can see, this bullish engulfing is small. It's not like the engulfing didn't close like all the way here. Because sometimes a bullish engulfing can close all the way so far away from the candle, but as you can see, this bullish engulfing closed right above it. So I like these kind of bullish engulfings. It's not too far. So in fact, depending on how I'm feeling, let's say I really want to be in the trade, I won't even enter at the 50%. What I'll do is I just enter right there. Why? Because the risk reward is probably still very, very favorable. I try to put my stop loss below here. As you can see, it's just around 100 pips. So I would just have equate it to 100 pips and boom, that's it. That would have been my entry, and that would have been my risk profile basically for the day, right? And as you can see, it came up to like a 1-to-1 before whatever, even pulled back a little deeper, but because you put your stops below the low, you're safe, and then it pushed up and whatever. And then maybe I would have targeted something like the high here, or maybe like at the high of the range, whatever. That's the way I would have entered this trade had we not had FOMC today. But knowing that there's FOMC, in fact, let me be honest. This is all in hindsight. A version of me might have entered despite it being FOMC. Why? Because a version of me would have been like, you know what, this might be the entry, and then the price might trade away, and then when FOMC comes in, it'll just shoot up. So I might want to enter early. Maybe what I do is I go in at half risk, put my stop below here, but because it's FOMC, maybe I would have tried to get a wider stop. A lot of coulda, woulda, shoulda, right? So what I'm saying is one version of me might have entered, because honestly, I will say, when I know there's a big news release coming out and I really want to be in the trade, sometimes I do enter if I see a setup before the actual news release happens, right? I would enter the trade, and a lot of times it works out actually, especially, but then I'll be closely monitoring the trade right before the news release. If I see the trade going closer and closer to my stop loss, so what I would do in that situation is, okay, of course, like I said, I would enter with a reduced risk, so I would enter like half of the risk I usually enter with, but If I see, for instance, like let's say the price is just hanging around break even or maybe a little bit in loss or a little bit in profit, and I feel like if the news release comes, spreads might widen and I might get wicked out, so I would close the trade right before the trade. But if price just moves like significantly, not significantly, but a good amount in profit to where I am not scared of price wicking me out due to the release of the news and the spikes that happen at the news. Remember, I enter on the 1 hour time frame. So that's another thing you have to consider. That's why sometimes I feel like it's safe for me to enter trades even before news releases. Why? Because I enter at the 1 hour. I'm not entering at the 5 minute, 1 minute. That's where and then I don't have a like 5-10 pip stop. You see, this is a 100 pip stop. We're talking about 100 pips. So that's why when you're trading on the higher time frames, news is less of a issue. In fact, you want news because news is what really pushes your trade to your take profit. Like you said, we've been stuck in this range, and this news release is really the last saving grace for us to break out of this range. So in fact, when you're trading on the higher time frames, you really welcome news, and you welcome news while you're in your trades. That's what I'm saying. Whereas when you're on the lower time frames, you really don't want to be around news. You don't want to enter before news because you can easily wick out, with your 5, 10, 15, even 20 pip stop losses. They're nothing compared to the news, right? Especially with an asset like gold. So I say all that to say, if it wasn't because of this news, a stop below here would have been safe. Now, let's say I was a different version of me, would have entered right here. I would have been like, you know what? I don't care. I'm not even looking for confirmation. I'll just enter right there and I'll put my stop at the low. This is the protected low, right? The low that swept and then broke structure. So no matter what, your stop loss should be safe below here. But this is like a 200 pip stop, which is not bad, for gold. Remember, this is hourly time frames. I don't know if you guys watching trade on the hourly time frames and above, so I don't know if you can relate, but 200 pips. I mean, like if you look at my templates, I even have a 400 pip template. So sometimes my stop losses can reach that size. I'm trading gold. So yeah, that would have been really, really safe. And then you see now we're significantly up in profit. Currently running around like almost 1 to 2. I mean, the high was 2.4, and potentially just keep on going. If it gets to the high over here, that would be the nice one, 3.3. Blah 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 blah. So yeah, whatever. It is what it is. All of that. Yeah. So I'm just gonna wait till tomorrow. Let's see. Let's hope that this news release is the last straw on the camel's back that will enable us to exit this freaking range. But honestly, even though it was a FOMC news release, the reaction is kind of lethargic, to be honest, because I was expecting a bit more. But it has taken a certain direction, so let's just hope it continues overnight, and we'll resume here tomorrow, and hopefully we'll have some good news of us breaking out of the range and getting some trades in. I want to stick to my principles. Well, not my principles, but my decision to not trade, right? I made a decision. I said I'm not going to trade, and as such, I've had a very, very slow week, still stuck in this range. I don't know how much longer, but like I said, hopefully we'll break out of this range maybe by tomorrow, and we'll be able to get a trade tomorrow. Will be Thursday. Maybe we'll get a trade on Thursday. If not, maybe Friday. If not, maybe we don't get a trade this entire week. And we've just been analyzing day to day. Man, this has been a really long video. Let me end it here. So yeah, I'll see you guys tomorrow. Peace out.